So we're now going to start formal course material. Start of every topic, I'm always going to have a slide that summarizes what we're going to do in the topic. It's, you can kind of think of it as check marks that we're going to be going through as we go through the notes. So this first topic, I call it Introduction and the Life Cycle of Startups. Today's lecture, what we're going to talk about are, a definition of startups, and given our definition of our specific definition of startups, what are some of the key and unique characteristics of startups and implications of that uniqueness. So given what's unique about startups, what becomes unique about their life cycle? What is unique about their funding life? You'll notice in this class, I use the word life cycle a lot because really startups are evolving creatures, right? So it's not like you're an adult and you will stay an adult, right? It is, you are a child who will become a teen, who will become a McGill, awesome BCom student, who will then become an amazing adult, right? Life cycle, it kind of matters here. We'll talk a little bit, again, high level, about the unique analytical challenges associated with startups. Talk also briefly about the unique way that I think about classification of startups. There's an implication that I haven't included here, but I also have in the notes. I'll probably not have the time to talk about it in class today, which is a unique distribution of returns for startups as well. But I will be re-emphasizing that point many times during the semester. So even if it's in my slides, not discussed, I will be mentioning it later anyway. So it's not going to be something that you guys are totally oblivious to. So that's what we're going to do today. The rest of topic one after that is going to be really going into much more nitty-gritty and covering a lot of real-world examples of each of those stages of the life cycle of startups so that we can really understand, as I said earlier, the challenges that startups systematically tend to confront over their life cycle, and some of the creative and interesting ways that various startups have successfully navigated that. I think very much in a startup context, it's helpful to keep track of startup stories, both successes and failures, because those things can be really informative for thinking about what sort of advice you would give to new startups that seem to be navigating similar oceans, so to speak. So if you guys don't mind, modules 2 to 5, I won't go and summarize more than that for now, but we will discuss them at length each time. All right. But let's go ahead and start the first part. So I want to start with a definition of startups because, as I said earlier, the course may say entrepreneurial finance, but really I think of this about startup financing because I make a distinction between two types of entrepreneurial ventures, right? Small scale entrepreneurship, you're opening a restaurant or something like that, right? Versus the really high scalability, high ambition type of entrepreneurial venture that we come to associate with oftentimes technology, but not necessarily always technology oriented startups, where the goal is to build something that is going to become very large. Those are two very different things. And the way you analyze them is completely different. The way they get funded is completely different. VC is only interested in one. It's interested in the startups. It's not interested in small scale entrepreneurship. Right? So I'm only focusing on one because that's all we can do in this course anyway, right? But I want to be absolutely clear about that. And so then the question becomes, well, how should we think of defining a startup? Because that's going to inform a lot how we analyze these startups, what sort of advice we give to them, and a lot of the things that we end up discussing in the course, how we evaluate them, how we value them, so on and so forth. So I'm going to give you guys a definition. But actually, I'm going to build my definition off of descriptions of startups that people with much more real-world experience than me have provided in public domain. So I actually have quotes here, which involve morsels of the definition of startups coming from 5 different prominent practitioners in the startup ecosystem, a mix of founders and investors. All right. And each of these definitions that get highlighted here are picking up a key and unique ingredient of a startup. So I like them collectively. The sum of the parts is greater, whatever, 1 plus 1 plus 1 plus 1 plus 1 plus 1 is greater than 5. So the first quote is coming from Paul Graham, successful startup founder during the initial wave of .com successes in the late 90s, early 2000s, but most well known as being the founder of Y Combinator, which is the most successful accelerator program in the world. So Y Combinator was the first investor in Airbnb, in Dropbox, in Stripe. So extremely notable in its impact on the startup ecosystem. And Paul Graham is the key founder of that organization, although he doesn't run it anymore. It's one of the things, once you succeed enough times, you don't need to do it anymore. So who knows what the future of Y Combinator is going to be like. But this is something that Paul Graham says. He says, look, and this is going to kind of sound maybe a little bit trivial when I say it, right? But I still wanted to include it because it's an important fundamental starting point. But Paul says, a startup is a company designed to grow fast. Being newly founded does not in itself make a company a startup, nor is it necessary for a startup to work in technology or take venture funding or have some sort of exit. The only essential thing is growth. So to me, this is really the starting point of a definition of startup. It's really about ambition. Okay, a startup is something that starts at nothing, but wants to go damn far, right? It doesn't want to build a $10 million business. It wants to build a $1 billion business. A lot of people would be very happy doing something that's $10 million. A startup, that is not their goal. That would be viewed as a meh-ish outcome, okay? So the goal is really to achieve huge value. So to have a meaningful component of an important and growing market. General rules of thumb around that is you want to think of a company that can be worth $1 billion, or you want to think about a company that could achieve annual revenues of 100 million, or is entering in a market where it can capture meaningful market share, where the market is like $1 billion a year, right? These are the kinds of hurdles that people are thinking about when they're thinking about what's the right level of ambition. So that's a starting point. That's like criterion 1 of a startup. It's that really supercharged ambition, okay? What are some other elements of the definition? So another definition comes from Eric Ries. Eric Ries is a serial startup founder, successful, has had multiple $100 million plus exits, not from recent times, but from, let's call it a decade ago or more, when 100 million actually was something. I guess it still is, but now people shoot for $1 billion, right? But Eric is also probably best known as being the author of the book, The Lean Startup. And that's really a book that, alongside another book written by the next person I'm quoting, Steve Blank, has really had a deep impact on the way people in startup ecosystems think about early life startup strategy for startups. Hi, Deborah. So that's a great book, by the way. I'm not going to assign it in this course, but it's a really quick and easy book to read. So I highly recommend people read it. It's literally the kind of book where, you can read it, 10 minutes a day before you go to bed, and you'll be done reading it in 2 weeks if you're a moderately fast reader. It's short and easy, and it's worth it. But he has a great quote in this book where he says, look, a startup, okay, he uses the word human institution. I don't know why that's necessary, but what I care about is it's an institution that's designed to deliver a new product or service under conditions of extreme uncertainty. So this is super important, the extreme uncertainty element of startups. When they start, if things go well, they can reach $100 million in annual revenue, but there's a great chance that things aren't going to end up well and that they'll potentially and often go to zero, right? So there's a lot of uncertainty here. And because of that, there's not a lot of historical data, right? It makes it difficult to do a lot of things, right? But that's basically that's something that you see almost entirely for early stage startups, right? You're taking a bet on something that you think can happen, but there's a lot of questions on whether that will actually happen or not, right? Steve Blank who's actually probably the main mentor of Eric Ries, serial founder, also someone who lectures on entrepreneurship at Stanford Graduate School of Business and the Huss School of Business at Berkeley. And he has written an absolutely wonderful book called 4 Steps to the Epiphany, I think. I might be remembering the title a little bit wrong. That's like a supercharged version of Lean Startup, but it's also one that will take you much longer to read, like 800 pages long. But he has a great quote. He says, look, a startup is a temporary organization set up to search for a repeatable and scalable business model. So what does temporary mean? It's about evolution. What you're trying to do early on is figure out how to get to this large ambition, right? So you need to find something that people want that you can deliver to a shitload of people, right? Because it needs to be scalable for it to be able to reach that ambition. You could have a big market, but if you're not able to scale production, you're not going to capture a meaningful share of that market, and you're not going to generate enough value to achieve ambition. So you need scalability, right? Your goal is to figure things out early on as a startup. That's why you're in temporary mode, right? And in order for you to reach your ambition, it needs to be scalable, repeatable, predictable, some combination of all those things, right? So that's a really important goal. The extreme uncertainty means that Ries emphasizes means that you need to be learning early on with a startup. It's less about experimentation. It's more about, it's less about execution, and it's more about experimentation, right? Because you need to resolve that uncertainty so that you can ideally evolve into something that's predictable, scalable, and worth growing. The founder of 500 Startups, another prominent, it's a prominent angel investor group. He says, a startup is a company that's confused about 1, what its product is, 2, who its customers are, and 3, how to make money. That sounds like a fairly bad predicament, but it's a great description of a lot of startups, because you might have an idea on what you should build and who you should sell to, but because of the uncertainty, you don't know for sure. So you need to validate that your hypotheses in terms of where you're trying to go are actually correct, right? And so this does a good job telling you the different wrinkles of uncertainty that Eric Ries is talking about. You're literally uncertain about almost everything. Got to figure things out. And that's early goals for a startup. It's to resolve uncertainty. It's not to make $100 million in revenue every year right away, right? And then the final thing that we see in the definition is coming from Mark Andreessen, who was one of the founders of Netscape, which was the first popularized consumer web browser. It really kind of marked the start of the dot-com bubble in the early 90s. He's also the founder of one of the most prominent Bay Area venture firms, which is Andreessen Horowitz. The shorthand for Andreessen Horowitz is A16Z. If you take Andreessen and Horowitz, you've got the A at the front, you got the Z at the end, and there's 16 letters in between, apparently. So he's really viewed also as a thought leader amongst investors in Silicon Valley. And he says, look, a startup seeks to build a real high growth, high margin, highly defensible business. And what we're talking about here is long-term margins and the ability to preserve them. Those things need to look attractive, because you know what startups do early on in their life? They do a lot of things, but from a financial perspective, they lose a lot of money. So if your cash flows are negative for many years, the only way you can generate value today is if they eventually become rather quite positive, right? And that can only happen if you're able to defend your turf. So you need defensibility, because if you don't have defensibility, you get the pleasure of losing a bunch of money while you're trying to figure things out. And once you've figured it out, all the entrants come in and erode all your profits. That seems like a fool's game. So you don't want to be the fool. So you want to identify businesses that you believe once they succeed and everyone knows about it, they can protect their turf. Without that, you shouldn't be optimistic as an investor, even if you think society will eventually benefit in this. Any questions so far? Or so far seems to make sense? Everything I'm saying makes sense, right? And I'm saying it. I'm not saying I'm reading it. I summarize these definitions here, right? So it's about ambition and upside, right? We've got uncertainty and we need scalability to be able to achieve our large ambitions. In terms of uncertainty, we've got different types of uncertainty. What to produce, right? And it might be, we know we can produce it, but we don't know what the features should be. But it could also be like, we don't know if it's even possible to build this, right? So there's both those types of uncertainty inside of product uncertainty. There's what we call beachhead market uncertainty, which is usually the original market that you try to tackle for a startup is a subset of the total market that you hope to acquire in the long run, right? Facebook's initial market was what? Students at Harvard. After that, college students. After that, the entire world, right? How do you sequence that in a way that maximizes your likelihood of success? You need to be deliberate about this. So beachhead market uncertainty. You're not sure what you should be tackling. You need to try to figure that as well as you can, as quickly as you can. Then there's also go-to-market uncertainty. What is go-to-market uncertainty? So you know you have a great product that a target audience loves. You know that, but the audience doesn't necessarily know that. It's not one of these things in life where if you build it, everyone magically comes. You need to figure out how to get people to be aware of the value proposition you offer and to want to come to you, right? You see this a lot, by the way, with startups, because a lot of startups are founded by technical people who love making product, right? They want to design a new gadget, right? And a lot of these kind of engineering type people, they think sales is just a bunch of people in our programs who are just basically stealing a bunch of money from them, right? They don't realize like it's actually really difficult to sell. Going to market, even with a good product, is not an immediate thing, especially if you don't have a big marketing budget. So you need to figure out how to make your customer acquisition, right, scalable as well. It's not enough for you to have a product that you can build 1 billion of. You need to find 1 billion people to buy it. And that's a go-to-market uncertainty, which is different from finding the right product and the right way to build it. Then after you resolve that, another type of uncertainty is market expansion uncertainty, right? Because you might figure out the go-to-market for college students, but how do you go from that go-to-market to a broader go-to-market that gets everyone? In some cases, it's pretty easy to go from one to the other, but in other cases, you need to refigure things out completely, right? Maybe you're like a startup in the healthcare sector. You figured out how to grow in Canada, fabulous. Now you want to expand it to the US, which is a humongously bigger market, but guess what? Different regulations. Got to figure that out. Totally different, right? And so market expansion uncertainty is kind of like, how can you figure out go-to-markets for more and more markets beyond the beachhead, right? These are all different types of uncertainty. And early on, you don't know those things. You need to figure them out. So you need to figure out what should you prioritize in this list to figure out first, and how should you deliberately tackle all of these things, right? Another defining feature that actually wasn't in the list that I mentioned, but is that you start poor. Most startups don't start with like like a completely tappable pool of resources. They, have to figure out a way to do things on the cheap because there's so much uncertainty. It's not everyone is willing to give them resources, right? And so you need to figure out how to resolve all this uncertainty in a cost-efficient and timely manner. That becomes an important part of startup strategy. Initial resource constraints are something that are hovering around the whole universe of early stage startup strategy, operations, what they're trying to do. You got to think about it, and it informs on a bunch of the things that we see that are a bit more unique for startups than for other things. And then the defensibility thing, which I think is pretty clear. So I don't feel the need to re-emphasize that again. Mark Andreessen put it nicely already.
Hey, Jiro.
Yeah.
I had a quick question, actually.
Girl, by the way.
I was uncertain as to like what the differentiator is between beachhead market uncertainty and go-to-market uncertainty. It kind of seemed like the two kind of intertwined.
Um, like, well, I mean, just think about it, right? You you build a product with a certain customer in mind, and you may be awesome at building products, so you build a great product for them. It's not like they magically learn that you've successfully done that, because there's a lot of people trying to sell me shit every day, right? And so those are two nuts to crack, not one, right? One is identify who you're selling to. The other one is successfully sell to in a way that's predictable and scalable.